How is everyone doing today? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I've got to have a great discussion here with Patrick Wood. He's going to talk about his company. He's going to talk about a special new product that he has that just came out. I think everybody's going to find this really interesting. So strap in here. Here we go. So, Patrick, how are you doing today?
Great, Joe. How are you?
Great. Hey, thank you so much for coming on.
Thank you for having me.
Great. So I was hoping we could kick it off here by just having you kind of tell us a little bit about your company, which is, if I'm saying this right, DelphX Capital Markets, and just tell us a little bit about what you guys do, what your focus is.
Sure. Yeah. So thanks for having me again, Joe. It's great being here. DelphX, so DelphX Capital Markets Inc. is a publicly traded company. It's actually not my company. There are a bunch of shareholders that it's their company, but I'm the head of the company at this stage. But DelphX is like I said, it's a publicly listed company in Canada and the US. Our symbol in the US is DPXCF, and in Canada, up in the TSX there, it's DELX. But it's an interesting company because it's a company that is in the credit market innovations segment. And DelphX has been around since, I guess, about 2012. Company went public in 2018. It's had multiple fits and starts since its inception. But the original premise to the company was to essentially build a better mousetrap to credit default swaps. Credit default swaps at that point in time were completely crushed. If anyone's seen the movie, The Big Short or Margin Call, and anyone who's around back then, they'll remember 2008 and what a devastating effect that had on the credit markets, in particular the credit default swap market. So DelphX was formed, like I said, originally the intent was to build a better mousetrap, a better credit default swap. And what happened though, which is very common in a lot of these small nano micro cap type companies, is the company had very difficult products that were too intricate, products that the street didn't actually want. But that the company itself thought that the street wanted. And that was a big no-no. So reluctantly, I stepped in as CEO. I was a large shareholder in the company about 4 years ago. And since that time, what we did is we really broke down, the product portfolio, realized, very quickly that we had a, real loser company with really, I have to say, like really bad products. But we leveraged the fact that we were a public vehicle, the fact that we had really great shareholders, to go out, find, some of the best advisors, some of the best talent we could on Wall Street, which is, it's not Wall Street anymore. Let's call it Midtown New York, but find the best talent out there, best advisors, bring people in and build a product that really did fit a need and a product that addressed a need that wasn't being met. And it was by, going through those steps and also really going out there and talking with the clients, the people who would, generally use this product to get to the point where we've developed something that fits a very, very big role, a need. It's a standalone product, but it really addresses risk management for insurance companies, particularly insurance companies who hold large credit portfolios of bonds, and most importantly, triple B bonds. So bonds that are on the verge of going from investment grade down to high yield. And so I'll talk a little bit more about the product in a sec, but
before you segue into that, so who would be your like a typical customer for you? Like, in other words, are you guys working with bigger banks on Wall Street? Do you guys focus on insurance companies, other types of businesses? Like, what's a primary customer that you guys would work with?
Very good question. So we have two primary customers because what we have is we call it a multilateral trade. There's one component that an insurance company will buy. They'll buy protection on their bonds being downgraded. And I'll talk a little bit more about the mechanics of the structure in a sec. But on the other side, you have a hedge fund. So we've partnered with two major hedge funds right now who are going to be the sellers of this protection. And we have, a roster, quite a wide roster now of insurance companies that have given us bonds to market to these hedge funds. And essentially, we're really at a great point in the company now where we're launching the product in the next few weeks or so. So this is a fortuitous time to actually have this chat, Joe.
So that's pretty cool. So you guys in a sense would find like the insurance company that needs this product, and then you guys would kind of
Correct.
match them up with one of the hedge funds you're working with.
You got it. So we are a broker dealer, and we're a small company, but with a lot of young people, which really makes a big difference. One thing that your viewers will understand, a lot of them, is that doing something new on Wall Street is next to impossible. Broker dealers, they have an absolute reluctance for innovation. They absolutely well. I think most of our experience with the guys on Wall Street and the broker dealer channel is that they're generally a couple bonus cycles away from retiring. The last thing they want to do is take on any risk and try something new. Which, by the way, created a great gap and a great entry point for small little DelphX to come along and build a dynamite product, something that they should have invented, they should have developed. But like I said, there's no innovation anymore on the street, which is once again, it's been a great opportunity for us to kind of climb in there and almost backdoor them, in the sense that we created this and through our own broker dealer now, and we aligned with another broker dealer called Castle Placements out of the US. Fabulous group of guys to market the product to insurance and hedge funds. So that's the point that we are at now, in the sense that we have active negotiations going on for very large portfolios of bonds. Which is great because, like I said, as a small public company, getting commercialized and having revenues is the end game. That's what we need to do, and that's what we're doing now.
Perfect. I think that's a great segue. So one of the key things we wanted to talk about was this new product that you mentioned, which is called the Credit Rating Security, or the CRS. And so I think, so I'll hand it over to you. So tell us all about this great product you guys developed.
So credit rating securities are, like I said, they're unique. They're pretty esoteric in a way, but they're known to the customer in the sense that it's a painkiller for downgrade risk. And what happens when an insurance company owns a bond that's let's say it's triple B, just a straight triple B bond, they're paying a capital charge, which means that they have to have capital set aside for holding that bond, which the NAIC, which is the insurance regulator in the US, regulates, and they say, look, you have to put aside 1.52 percent on that bond. You have to put that, like I said, in reserve capital. So that risk-based capital, or that RBC for the insurance companies, is a painful point. They hate that stuff. Mm-hmm. What happens though after that, if the bond gets downgraded? So, for example, like Boeing recently has been in the news. Their planes are falling from the sky, and just a little bit, just a little bit of a blip. But look, I mean, at the end of the day, an insurance company who holds Boeing bonds, and I'll tell you, there's a lot of big insurers out there. Top 10 American insurers hold a lot of Boeing debt. If you own Boeing though, and you got a 7-year bond, you're pretty comfortable with the issuer. It's one of 2 large aircraft, manufacturers in the world. Boeing isn't going bust. But in the meantime, as you hold that bond, if the bond is currently triple B, and if it gets downgraded, let's say to double B plus, which is very theoretically possible. I mean, it seems to be kind of headed that way, and that's where the rating agencies are pegging it now. Well, your capital charges increase from 1.52 to something like, I think it's like 3.15. So that's a big jump, and you have to, as an insurance company manager. So if you're, the PM, the portfolio manager of that portfolio, you're really in a tough jam. And there's no way to really protect yourself against that. But by using our product and buying protection, you can buy some protection on that bond as much as that notional amount of the bond that you own. You can pay a premium for that protection. You buy a put option, which the hedge fund will fully collateralize. They'll put aside some money in a treasury with Bank of New York Mellon, who's our custodian. And that, so there's no counterparty risk like, credit default swaps used to have and other instruments in the past. But you're essentially buying yourself protection such that if the bond gets downgraded, whatever that notch lower is in your capital charges, the insurance or the hedge fund has it covered. So you're really, you're using risk management and a new tool in risk management, which as an insurance company manager, you should be always looking at how can I better insure my portfolio. And unlike CDS, which is terminal, it's more of I call it, a life insurance type product if you're thinking of insurance. Ours is more of a health insurance product. It gets the insurance manager through a tough time where the issuer is having, a real kind of stinker year or two, i.e. Boeing. And so you can, it's sleep well at night insurance or protection. And like I said, it gets you to the point where you can continue to comfortably hold that bond, but you've done your fiduciary duty. You've protected your policyholders from being really, really hurt by putting on this type of protection. So we're in the middle. That's how we operate. We're a standalone. We're an issuer of these securities. Really, our role is essentially to issue the two securities, one to the insurance company and one to the hedge fund. And like I said, everything is done through Bank of New York Mellon. So it's a unique structure. For sure.
Yeah, no, I mean, a very, very fascinating product. I'm intrigued by this whole thing as you're describing this, and you got my wheels kind of turning here. So I'm just curious. Let me give you a scenario real quick. So,
sure. Yeah,
because I'm wondering how this might be able to actually work for banks. So I'll give you a scenario. Last year, we had a little bit of a banking crisis. You had Signature Bank and Silicon Valley Bank fail, and a little bit. So that happened in March, April last year. And then toward the end of the year, as we got to like September, October, you had Moody's downgrading a number of banks, particularly regional banks.
Yep.
And you've got this issue in the banking business right now where you've got what's called unrealized losses on their bond portfolios. And it's a pretty massive issue right now. The banks are down negative, $500 something billion in unrealized losses on their bond portfolios. Now, that's not to say that the banks will actually lose that money, because if they do hold those bonds to maturity, they'll get paid out. They're not going to lose the money there. The issue comes in, it's more of a liquidity issue. Like, in other words, if the bank gets in trouble and they need liquidity, they would be forced to get rid of those said bonds at a loss to try to get some liquidity back in. And that could cause a ripple effect, basically like what happened again with Signature Bank and Silicon Valley Bank. So I guess my question to you is, if you're worried about if maybe the insurance company holds bonds on banks, or vice versa, maybe the bank is holding a certain types of bonds in their portfolio or something, and maybe the bank is worried about downgrades or getting downgraded or something like that. I mean, do you think there's any way this might be able to work in some way, shape, or form for some of those different parties there?
Absolutely, Joe. Absolutely, yeah. So this is a very versatile product. We have two versions. I'm only talking about the one for insurance companies specific to capital charges. Our other version of the product is spread and duration based. So, for example, if you own that Boeing bond, or let's say you're a bank and you own a big property bond in CRE, commercial, real estate type, and it's, it happens to be an office tower, and let's pick a stinker market like San Francisco today. Definitely not down here in Miami. You're doing great, but in San Francisco, that bond, you've got a lot of exposure there, and the value of that bond will fluctuate. So the spreads or the price on the bond will fluctuate greatly, but to protect yourself against those downgrades in the bonds, if you're a bank that owns a lot of that stuff, we have a version of the product which uses spreads. So, for example, if the spread on the bond at outset is 200 bips over the risk-free rate, and the bond gets downgraded, and if that trigger is hit, and the trigger is always identified at the outset of the transaction, if the trigger gets hit, and if the bond has increased or decreased in value, and the spread has gone up to 400 bips, there's a way to protect yourself against that change in spreads. And we do have a product that we've actually launched alongside the insurance product, the capital charge product, which is ready to go as well. And that is a more universal type product. that thing, guys like banks and others would use. And we've also been asked by a lot of people like, hey, you know what, my CLNs, my loan note portfolios are really getting hammered, especially in CRE and those regional sectors in banking. And we've had a lot of demand to expand the product to that marketplace as well, which we intend to do as soon as we get this, this first kind of grouping of transactions out of the way. Then we're really going to expand this to make it very far-reaching, because it is a better product than credit default swaps. And CDS is the only other thing out there that's standardized that people use to, really think about protecting their exposure to bonds. But CDS is notoriously unreliable in the sense that it's terminal. You don't really have any counterparty. Well, you're not supposed to have any counterparty exposure, but you do in CDS. Mm-hmm. This is a fully funded product on both sides, so there's no counterparty risk. You don't care who your counterparty is, because you're counting on the U.S. Treasuries that they're not going to blow up. That's your counterparty, but the collateral is always there. But yeah, and it's a great point though, Joe, that there are a lot of segments in the economy that people have approached us with. They said, yeah, listen, I'm really worried about this. How can I protect myself on this side? So yeah, like I said, we're trying to think at least, and I'm sure we've left out a lot of things that we haven't thought about, but having two very standalone products that protect people against downgrades. It's the only product of its kind. There's nothing else like us out there. So that's what makes this a really exciting story.
Yeah, no, absolutely. I agree 100%. I think this, like I said, I'm fascinated by this product. I mean, it's like you said. I mean, they're really I can't recall hearing really anything like it out there right now on the market. I mean, it really is fascinating that your company was able to kind of work this and put it together. I'm kind of curious, like, how do you guys measure this in terms of, obviously the bond market is a ginormous market. What how big do you guys think that this product could get for you in terms of like just business sales? I mean, do you guys think this could become a billion-dollar, multi-billion-dollar type market for you in a way?
Yeah. So, I mean, our starting point, Joe, is this U.S. corporate bond market, which is about $17 trillion. $3.5 trillion of that is triple B bonds. And a large chunk of that is owned by insurance companies. They're like the biggest buyers of debt out there, some of them at least. But and they're Goliaths. If you think of the top 10 insurance companies in the U.S., I mean, they're huge. And everybody knows them by name. But so this market is massive. It's a great starting point for us. If we are able to penetrate just a small fragment of the market, it means hundreds of millions of dollars of revenue to us. And we have a very, very thick, beefy, bottom line to suit that, because our costs are very, very low. So, and the way we make money is very simply as the issuer of the trade. We charge both sides, the insurance company and the hedge fund, a fee. It's either 10% of the premium that the insurance company is paying over to buy the protection, or it's a minimum of $100,000, 50 grand on each side. But our costs fully baked in after that are probably about $20,000 per transaction. So we have a really nice bottom line. And right now the first grouping of transactions we're contemplating is about maybe 3 billion notional value in bonds, and that's across 60 different bonds, 30 bonds, but two hedge funds doing 60 or 30 bonds each, so 60 bonds. So anyway, it's an immediate $6 million in revenue for us, for the company, which is, like I said, that's a nice starting point. But we also know this, and this is what makes us really exciting and compelling, is the fact that Wall Street does have FOMO, as do insurance companies. So, if one insurer sees that, his pal at another insurance company, that she is buying protection, well, he's going to say, oh my gosh, I've got to do this as well, because otherwise, I'm going to get fired because I'm not mitigating my risk, and other people are. Likewise, on the hedge fund side, other hedge funds, have very clearly said to us, hey, the minute this is up and running, we want to be part of this. So there's going to be no lack of demand on either side. And to be quite frank, I mean, we've spoken with pretty much all the broker dealers, like the big ones on the street. And, they all As I alluded to at the beginning of the conversation, I mean, they all say they have no bandwidth. They don't want to take on anything new. But once again, the minute they sniff that P&L is being lost, they're all going to, it's just going to be, once again, all the animals running onto the ark as the ark has already left the building, so to speak, and that is 100% what happens with something like this. And because we are a standalone neutral party, having somebody else come in and replicate this, we know by virtue of experience, how long it's taken us to build this product, with top legal and regulatory, kind of work and much more. Our secret sauce here is that, like I said, we're a neutral party. We definitely are coming out of this as the, the OG of credit rating securities. And we think that's going to give us a big, huge head start over people coming in and trying to rip us off, which inevitably somebody will. And that's not a bad thing. Patents are lotteries for lawsuits. And that's not the game that we want to play. We just want to be first market mover. And that's, like I said, in the world of finance, I think it's better to have your product replicated. Because if a named dealer, came out with this product, people would be very reluctant to go with a named dealer because there's always bias. You never know who's making the market. You can never really trust any of these guys, the big dealers, as far as, they some of them have very bad reputations, which people, who were around in 2008 haven't forgotten. So having a little neutral party like us in the middle is, especially with, the partners we now have, like I said, Castle Placements as a partner and an owner in the company now, these two massive hedge funds, we can't really share their names quite yet, but, they're great. So like I said, we have a lot of protections in the sense that we've already got the product ready to go. So.
No, yeah. I love it. It sounds fantastic. Yeah. So if I can for a second, Patrick, if we can just kind of switch gears, I know you have a long background in financial services, but could you just tell us just kind of quickly, like just a little bit about yourself? I mean, how did you end up? I know you had mentioned earlier you were a shareholder and you kind of stepped in as CEO. Yeah. But I mean, how did you kind of make this path to this point in your life?
Yeah. So I think, what is it? So we're so I've been in capital markets for 30 years now. And I've pretty much worn every hat you could possibly wear. Stockbroker, bond trader, institutional salesman. I was a VP, at two large dealers. So my history is very varied. Retail, institutional, and then I guess it was about 10 years ago. Or maybe even longer than that, maybe like 12, 13 years ago, I said, you know what, I'm getting out of the bulge bracket space and I'm going to start up my own advisory. So I did. And it was a company called Tormont Group. And we were based out of LA, Toronto, and New York. And it was a great, kind of segue for me to kind of move outside of the brackets of official, kind of capital markets, gigs. But, so we focus a lot on private equity. We did, every category of asset you could think of out there, we were involved in. So technology, definitely healthcare, a lot of biotech and other unique industries like the cannabis industry was a big one at one point. The crypto industry was a big one at one point. So, we filled a lot of roles there. And DelphX, funny enough, was a company that I advised and took them public in 2018 through that, through Tormont Group. So, like I said, it was an interesting, it was one of the interesting ones that we did take public. And we listed them up in Canada, which used to be a really great way to do things. So I did that with a lot of really great US companies too, took them up to Canada, took them public up there because it used to be a great model. It was fast. It was easy to go public up there. You had a lot of institutional and foreign support of the markets. I don't know if it's like that anymore. But like I said, DelphX was one of the ones that I did take public. Like I said, management blew it badly. So I had to step in, like I said, very reluctantly. Being a public company CEO is the last thing I really wanted to do at the time. So I was having too much fun, and this has not been fun at all for 4 years. It's been absolutely arduous, but it's getting more fun now. But Yeah, so that's my story.
Well, it sounds like you're getting to the rewarding part. It sounds like you put all the hard work and
I
the
hope
time and
so.
the blood,
Yeah.
sweat, and tears, but yeah, it sounds like you're just on the cusp of getting to the really good part. So
Yeah,
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 yeah.
we're
Hopefully,
hoping so, Joe. We're hoping so. I mean, we seem to be there, but we've had it's been so challenging, and turning a company around and really rebuilding, a new product, and then building a new marketplace too. Two huge challenges that it's a lot, and you really have to know your client. You have to know who what people want, and you have to know that they're going to use the product to really confidently support it, fund it, go back to, investors every month or two and ask them for more dough for mostly our legal expenses, because, a product like this requires at least 20 to 30 million dollars in legal expenses over the years.
yeah,
It's a lot.
I can imagine.
So
Yeah.
yeah. I mean, it's next level. And lawyers aren't cheap, especially securities lawyers.
No, definitely not.
No, like
No.
I think, $2,500 an hour per person. Yeah, no,
Oof.
it's definitely it's up there. But once again, to do it right, that is the cost. And as I tried to explain a little bit, I don't know if I was able to do it well, but our upside on this is it's gargantuan. And
Yeah.
yeah,
Yeah. Absolutely. Okay, well let me wrap up here with the last two
sure.
questions I have here for you. So I always ask every guest that comes on, it's
Yeah.
just part of the kind of pop culture thing that I do. But do you have a favorite business book? Do you have a favorite business movie?
So favorite business book is the biography on Bernard Baruch,
Aha,
Barucha.
great
Yeah.
one. Yes,
Yeah,
classic.
so yeah, he is absolutely, and I think that the one that I most recently read was an autobiography. It was actually Bernard himself telling the tale about how he started, funding railways. I mean, there was no such thing as insider trading back in the early 1900s, and
Yes,
anyway,
yes.
so but he was also the
Well,
finance. He was
and
the
just real quick, just for the podcast audience, if anybody doesn't know who that gentleman is, he's considered a legend on
yeah.
Wall Street. He's an absolute legend, and he has. I think there have been a few books that have been written about him. But yes, just absolutely. If you ever get a chance to check out, the guy had an amazing life, a fascinating life, especially in the world of finance and Wall Street. And so, yes, but please go. Yeah, continue,
Yeah. No, I
Patrick.
mean, look, man, actually that's my favorite movie, or my favorite book right now. But for a good movie, um, good business movie, I would say for any young person looking to get into capital markets, I think there's a couple of movies. I think Glengarry Glen Ross is a
Oh, yes,
great one.
classic.
Really, just shows you how awful being a salesperson really can be at times. And it's awful, especially if you're dealing with mom and pops. I think institutionally, much better. But doing retail, forget about it. I don't think anyone should do that gig anymore. And I don't think they need to, because everything's ETFs and indexes these days. But I think that in and of itself was a great movie. And I think the other, well, there are a couple of other ones out there, but I guess one that's relevant more to what we're doing would be Margin Call with Jeremy
Yes.
Irons and Kevin Spacey. That was an absolutely fantastic movie, but it's very relevant to what we're doing, and to what we kind of we're seeing right now as a company too, that the makings of a fear moment are starting to come together a little bit.
Mhm.
Spreads are tighter than they've ever been in the bond market, which means that people aren't worried about risk. People
Mhm.
aren't really kind of, the markets are at all-time highs, but the undercurrents out there, you don't have a high growth economy anymore right now. You
Yeah.
have company, big fundamental changes like China falling out of bed. The world hasn't really kind of priced in the fear and certainly the risk trade yet. So in the bond market, which is the number one leading market in the world, it's the largest, but it also tends to lead the equity markets. We're starting to see, certainly we're starting to hear that managers are kind of thinking, gosh, you know what, this has been a really long run. Rates have gone up. Doesn't look like inflationary pressures are coming off too badly or too much here. So, all we need is an oil price shock, and there's a lot of geopolitical stuff happening right now, which
Yeah.
could really trigger a lot of chaos out there. And that's where, like I said, that's where people should be thinking at this stage, because the price to offset risk is quite cheap. They should be thinking, gosh, you know what, I should sacrifice a bit of yield in order to cover myself should things go the wrong way. And so, yeah, like I said, that's kind of what we see kind of happening at this stage. So
Perfect. Awesome. No, and I think that's a great point to wrap up here, Patrick. So I would just ask, if anybody wanted to contact you, what would be the best way for them to do that?
Sure. Yeah. Best way is to go to our website, DelphX.com. So DelphX.com. And
Perfect.
yeah, there's a contact us area there. Reach out anytime, please.
And I will put, the website will be located in the description below. So if anybody wants to click on that and go to the website to check it out, please do so. But Patrick, this was an absolutely fascinating conversation today. I can't thank you enough for taking the time to just be on here with us. And I do hope that you will come back again.
Yeah, I hope so, man. Thanks, Joe. I really appreciate being on here. It was a lot of fun.
Awesome. Perfect. Well, we will see you again soon then, Patrick.
You bet.
All right. See you, man. Okay, everybody, that was Patrick Wood, who came on. Just an absolutely fascinating product. I think I learned a lot today. I hope everybody else learned a lot. And I'm sure that we will have Patrick back again, hopefully in the coming months, to give us an update on how things are going and maybe some just different developments or things with the company and different products that these guys are rolling out. So, but if you like this episode today, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, check out some of the other content on the channel, and I will be back to everybody again real soon. Thanks a lot.